Real estate investing almost always forces a compromise. You can chase reliable, long-term cash flow, or you can hunt for a high return on your initial investment. Trying to capture both at the same time usually means taking on physical assets so massive that the operational headaches eat away your margins. Queen City Capital Partners approaches this differently. While a typical investor might spend years managing a handful of single-family homes or small duplexes, Queen City bypasses that small-scale, piecemeal model entirely. Their objective requires strict aggression: acquire highly desirable properties at a volume that establishes them as a recognized leader in providing safe, cost-effective rentals. Moving away from individual building purchases and running acquisitions like an institutional-scale business is the mechanism they use to guarantee above-average returns for their investors, while still delivering practical value to the people living in those units. To make that institutional model work, the firm's daily operations are dictated by a rigid set of mathematical targets mapped out over a specific 3 to 5 year window. This chart illustrates their baseline volume goal: acquiring at least 500 rental units every single year. Looking at the overlay line graph, we see the financial target attached to that unit volume. That compounding property count is engineered to generate a minimum of $500,000 in pure cash flow annually. Hitting those numbers requires a highly restrictive purchasing criteria to prevent the timeline from ballooning out of control. They ignore small complexes entirely. Every property they target must contain 100 rental units or more. The sheer math of sourcing and absorbing 500 units every 12 months demands a highly repeatable pipeline. Every building they purchase serves as a functional cog in a volume-driven cash flow machine. Finding massive real estate complexes that actually offer favorable economics means deliberately looking away from saturated, hyper-competitive coastal cities. This map highlights Queen City Capital's specific hunting ground. They focus exclusively on emerging markets within a tightly defined footprint: Ohio, Kentucky, and Indiana. These specific regions offer the precise economic conditions required to generate a high-quality, reliable, and stable stream of rental income month after month. But identifying a lucrative market is only half the battle. Securing 100-unit complexes against competing buyers without overpaying and ruining margins requires a distinct acquisition strategy. Their tactic relies on being exceptionally easy to do business with. By operating with total transparency and maintaining the operational infrastructure to close deals quickly and smoothly, they remove the friction that normally bogs down massive commercial sales. Pairing a localized Midwest strategy with a reputation for rapid, headache-free closings creates an acquisition advantage that standard investors simply cannot replicate. Once a 100-plus unit property enters the portfolio, the strategy shifts immediately to the hold phase. The operational objective here is twofold: maintain safe, desirable properties for the renters while simultaneously protecting the investors' profit margins. The primary threat to that $500,000 cash flow target is overhead bloat. The operational and maintenance costs associated with running massive apartment complexes skyrocket if left unchecked. This organizational chart outlines their solution to that overhead. Queen City Capital does not manage the day-to-day operations themselves. Instead, they sit at the center and partner directly with established regional management teams. Outsourcing to these regional teams functions as a structural firewall designed to maximize overall productivity, minimize operational costs, and lock in target cash flow. There is a final, non-negotiable phase to the Queen City Capital model. These large-scale properties are never acquired to be held indefinitely. The firm enforces a rigid timeline across its entire portfolio. Every single property they buy has an expected hold time of precisely 5 to 7 years. Once that countdown concludes, it triggers the exit strategy, the intentional, calculated sale of the newly optimized property. This forced exit allows Queen City Capital to deliver a significant lump sum return on the investor's initial capital, completing the financial lifecycle of the building. The Queen City Capital pipeline operates by combining massive scale, focusing exclusively on 100-plus unit complexes, with a highly targeted geographic footprint in Midwest emerging markets. Their strict reliance on localized, regional partnerships safeguards their ambitious $500,000 annual cash flow target by stripping away excess operational costs. The speed of their acquisitions and their efficient hold period both serve one ultimate purpose: feeding that inevitable 5 to 7 year exit strategy that guarantees a return on investment. Queen City Capital Partners relies entirely on stripping the emotion out of real estate. By applying this strict step-by-step life cycle, they take massive physical properties and turn them into highly predictable, high-yield financial instruments.